Welcome back to the Takeoff Podcast. As you can see, we're not in the booth today, but we'll be back there next week. So I'm really excited about today's guest. We have Ryan, the founder of Making Money Simple. He's a financial content creator that focuses on making investing straightforward for the everyday person. He currently has a book called Stop Waiting and Start Investing, which has sold numerous copies, and I call him the Index Investing King. So how are you doing today, bro?
Yeah, no, I'm good, thank you. Thank you for having me on. Sorry there can be no fire in the booth today. Got to do it virtually.
No fire in the booth, yeah, I know, but it's fine. We're gonna definitely get you in for another episode, but I definitely wanted to connect with you to discuss index funds. But just to go over our usual questions, we always start off with the same question. So, what is your worst financial mistake?
I once bought a fake pair of Yeezys for 400 quid.
Really? How did
I think I might have
happen?
told this story before actually once on Clubhouse, but essentially this was like years ago when I was a teenager, and this was when there was only I think Kanye had just gone to Adidas, and it was only like the Pirate Blacks, the Turtle Doves, those ones, and I was really wanted to get a pair. This was obviously before I knew about personal finance and investing and stuff. I've done so much research, right? I knew all of the tells of what a fake was, but some bloke had uploaded real pictures and then sent me a fake pair for 400 quid. So essentially, long story short, I managed to actually get all of the money back, and I kept the fake pair because I think the guys got blocked from eBay, and then I sold that fake pair as a fake because they're still good. They're still good fakes, to be fair. But even like fake Yeezys would go for like 100, 200 pounds. So I think I sold them for and then like the genuine ones would be resold for like, back then it was like 400 or 500 quid. I think now they're even rarer because obviously them ones don't drop anymore, and there's a lot more drops now than there used to be. But yeah, £400 on a fake pair of trainers. I mean, I wouldn't even imagine spending £400 on hardly anything nowadays unless it's like a holiday. So the fact I spent that on a pair of trainers and they were fake was pretty abysmal, to be honest with you.
Wow, that's absolutely insane. My gosh. That's an interesting story, and it's great that you got your money back. What made you think, let me try and sell like fake, Yeezys?
Well, because I didn't want them because they're fake. I was like, I'm actually still never had a pair to this day. But I was like, I'd rather have a real pair. I don't want a fake pair. So I put them up as fakes, and then because they were pretty good fakes, I managed to flip them with £100 profit.
Oh wow. Oh my gosh!
Turn that bad around.
That's a way to turn a financial mistake into a positive.
It was a big mistake at the time though. Like 400 quid. That was like a lot. I must have been like 18 or 19. I've been saving up for ages. I was like, then they came and I could tell they were fake straight away. And I was like, here we go.
Wow. Why Yeezys? Just out of curiosity.
Yeah, I don't know. I was just like really into them back in the day, and this was when he first switched to Adidas. I'm a big fan of Kanye's music, and then. Everyone just sort of had them. I think it must have been first year of uni actually. I think everyone just had them and I wanted a pair. Yeah. Just getting them to try and, impress people. Well, you don't want to be doing that. And that's why I don't buy them anymore. I haven't bought a pair since.
Yeah. It's very interesting. You always have to think about why do you buy stuff? And I think a lot of it is because we're influenced by other people to want these things. It's not that we even really want it. We just want to show off with it. It's very, very interesting. Okay, cool. I love that story. Can you give us a bit of an insight into your day in a life at the moment?
Yeah, it's not massively interesting. So I'm an accountant in London. I'm now a qualified accountant, so I've finished all of my exams, which is good. But essentially I've a day job, 9 to 5, working in accounting, got sort of a few clients you sort of work on. And then a little outside of that, obviously Making Money Simple, to be fair, is quite a big sort of, it is a side hustle, but really it probably is a second full-time job at this point of the podcast, the YouTube, all the different social medias, the different products, the calls, all of that sort of stuff. And outside of sort of those two, I guess income streams, it's mainly watching football, going to football, going to the gym, obviously trying to go out, have nights out with friends, see my family fairly often. So it's very much just work, side hustle, sport, and friends and family. That's sort of
That's not boring. That's not boring.
I'd say it's standard. It's not I'm
you think it's standard?
Last week's in Dubai. Next week I'm going to the Maldives.
I mean, in the future, yeah, you might get to that. I mean, you might not even want that to be your life. Some people hate traveling like that because it's not fun anymore. It sounds fun, but I don't think it's fun when it becomes work. I think it's fun when you don't have to think about hard work. I think that's when it.
No,
I think that's definitely when it. That's interesting. It's funny that you say making money simple is like a second full-time job. I definitely agree with you there. It's financial influencing is definitely very, very tough and is a growing industry as well. Before you got into personal finance, what were you doing?
I was at uni, so I was in my final year of university. I'd just done a placement year, so in between like my second and third year of uni, I worked in industry for a year in London, and then that was sort of when I sort of like became like an investor for the first time. Well, I didn't know it at the time, but I got auto enrolled into my workplace pension. Like I'm sure with you, I was like, I don't know why. I think in my mind, I probably would have like, I wouldn't have done it. But the fact I was auto enrolled, I was like, oh, I'll just leave it. This is before like I sort of knew anything about money. And then I essentially started reading books about investing. In probably just sort of like going back up and forth on the trains all day. And then it was then sort of when I went back as my final year of university was then when I sort of really started reading loads of books, then sort of set up Making Money Simple, the like investing sort of platform I have. And then as they say, the rest is history.
Yeah. What's interesting is that I feel like your journey is quite unique because when I was at uni, I definitely didn't really think about my finances. I heard of Rich Dad Poor Dad as a book, but I think most of the books I heard about was like post uni. What gave you like this sense of urgency to be like, you know what, I want to know more about investing. I want to, look into these books. I want to, set up a page to teach others about investing.
I'm not really sure. The first book I read was Rich Dad Poor Dad.
Okay.
But I have no idea why I actually read it. I think I must have come across the YouTube video about passive. I think it was about passive income, about side hustles, and then people were saying how you need to invest in assets, you need to not have other income streams. And at the time, I'd worked for a year in London, and don't get me wrong, it was good fun. But at the same point in time, I'd only been doing that for a year, and I was like, I'm not doing this for like 45 years. Like going up and down, on the train all day, always delays. Sort of like doing this sort of like a lot of these jobs in like finance. Like people make them sound good, but they're all like pretty boring to be honest with you. Like even like if you're in like a really high job, they're still like I essentially like I realized quite early on I wanted to work for myself, sort of be my own boss. And ultimately have like time freedom, and then obviously with that sort of, I guess, financial freedom comes time freedom. But that was the main thing. Like I wouldn't really mind working long hours if it was for myself and building something for myself, which is what I am now doing and Making Money Simple. But I knew quite early on I didn't want to do it, and I think I stumbled across a passive income video, and then people talking about side hustles and read Rich Dad Poor Dad. So the first book I read was Rich Dad Poor Dad. Then I think the second book was The Intelligent Investor. I actually read that when I was traveling in the summer between my placement year and going back to uni for my final year. And then sort of after that, it sort of snowballed into, just like loads of investing books. Then I sort of like found index funds, what we're going to talk about. And then sort of just like built up slowly over time. I think it was probably a YouTube video and then Rich Dad Poor Dad that got me kick-started sometime during like it would have been like 2017 or 2018.
Okay. Wow. That was a lucky find. Lucky YouTube video.
Yeah, but
it seemed to change your life.
Yeah, I think it was because I had done work for a year though. Because I know most people just do their 3 years or do a master's. Because I'd done a placement year, I sort of then knew like, I don't want to do this until I'm 65. Like, it's not for me.
I completely get where you're coming from, and it's good that you have identified that early on, because some people 20-30 years and they're like, what have I got to show for this? What have I been doing? I've been working in a job that I don't like. I don't have that much time. I don't have that much freedom. I've just put myself into like a hole pretty much,
Exactly.
So wow. That's a very interesting thing. It's funny also that you said that you feel like you don't want to do this for 34 years. I've had similar thoughts as well. Like, I think for me personally, I want as much freedom as possible, as much time freedom. I know I'm always going to work. I know I'm always going to desire working, because otherwise I get bored. I'm not the type of person that I can sit on the beach for forever. It's not going to happen. I need to work. But what I want to do is I want to have freedom. So I spend time doing the things I want to do. And I also think as well, we don't discuss it enough, but working 5 days a week is overrated in my opinion. I don't think it should be the norm. I don't think working more than do other activities is the norm. So doing a 40-hour week, I don't think that should be the norm. And I think we should start talking about, let's do 25 hours to 30 hours a week and being a bit more efficient. I think that's where we should go, honestly. And I feel like that's where I've been reading, to be fair. I think Richard Branson, I think he might have said it a few years ago. I think the world is gonna go there. We already moved into the working from home, and I can see soon they're gonna be like, okay, you know what? Mondays and Fridays, nobody needs to come into work. Get your work done Tuesday to Thursday.
That would be amazing.
That would be amazing. That would be amazing. We'll see. I might campaign for it. I don't know.
I'll sign the petition, don't worry.
Okay, cool. Awesome. Thanks for taking the time to listen to this episode. I do really appreciate your support so far. If you do want to support the production of this podcast further and you want to get early access to the next episode of the Takeoff podcast, or you want to join in a monthly live Q&A, make sure to check out the link in my description. Either pledge to my Patreon or subscribe to my YouTube membership. Either way, I do appreciate you supporting me and helping me to build the best business and finance community in the world. I do hope that you enjoy the rest of this episode. So talking about index funds, can you give us a quick summary of what an index fund is and why do you prefer them?
Yeah, so I mean, first of all, it's probably easier breaking down the word like index and fund. So an index, there's a lot of indexes about, and people have probably heard of some of them in the news and stuff. So the FTSE 100 is an example. That's the largest 100 UK companies. The S&P 500 is another example, which is the largest 500 US companies. You can then get global index funds, which track the global stock market. Most countries will have an index, and essentially it's just a way, so like Germany has an index, Japan has an index. It's just an easy way to essentially track the biggest companies, I guess, in each country. You can then essentially group these companies into a fund and invest directly into all of these companies through one fund. So using the FTSE 100 as an example, as that's one people will probably be familiar with from the news being in the UK, you could invest into an individual company like HSBC or like Unilever, or both of them companies, by the way, are in the FTSE 100, or you can invest into the FTSE 100 index fund, which tracks all those 100 companies. So rather than betting on an individual company, you can almost bet on a basket of companies very easily through one fund. So the benefits of doing this are the ultimate benefit really is you have the whole passive investing versus active investing debate. So passive investing is where you essentially passively track a market. So you can invest into an index fund that tracks the FTSE 100, or you can try and beat the market, which is active investing. So you could try and pick individual stocks or try and beat the market. But if you look at like data and history over decades and decades, it is pretty much impossible to consistently pick those individual stocks that are going to beat an index fund like the FTSE 100. So the main benefit really is, first of all, you'll probably outperform other investors who are trying to pick stocks that beat the market. Second of all, because it is passive investing, you're just tracking a basket of companies. It's very low fee. And then third of all, inherently you get a lot of diversification, because rather than, say, as we said, investing into HSBC, one company, you can, or even 10 companies, all different. You can invest into the S&P 500, which is the 500 largest US companies, and immediately get diversification across all these different industries, all these different companies, all for a very low fee. And you haven't, I guess for me personally, it's almost just like such an easy way to build wealth, because I haven't got to be researching companies all day. I haven't got to be trying to outsmart fund managers or other investors. I literally just buy and hold an index fund, invest consistently, and then let the stock market, which averages usually around 8% after inflation over the long term, just let the stock market do the rest over time.
Yeah. And I completely agree with you, and I love the explanation that you gave. You broke it down. The audience are definitely going to be able to understand. And I agree with you. There's so many benefits to having an index fund. To be fair, I think the majority of investors, that's what they should look at, because they don't have the time to research companies. They don't have the aptitude to do it, the skill, and it's not, it's not saying that, this it's not smart or dumb, because there's also an element of luck. There's also how many millions of people invested in these companies. So there's so many moving variables that you're trying to predict all these different variables and hoping that it goes in your favor. And ultimately, out of all of this stuff, you can't even control it anyway. So when you think of it like that, yeah, an index fund is definitely one of the ways to go.
Yeah, you've had, like, you said so many things that I agree with there. Like, first of all, you literally cannot control anything. Like, you don't work in a bank controlling the money supply. You don't work for like on the board of a company making like decisions for like Apple. Pretty much everything is out of your control. Also, as you mentioned, people say it's like a boring or a lazy strategy, but regardless, it's still literally the best and easiest strategy there is. Like, if you look at the data, there's so much data going back so many decades, but on average, about 90% of active investors, whether like me and you are picking stocks ourselves, or you give your money to an active fund to then pick the stocks themselves, 90% plus over a 15-20 year period will underperform the market. And these people are like MBAs from Harvard. They're like working 12 hours a day. They have hundreds, if not thousands of analysts. They have millions of dollars to spend on research. They literally know the CEOs of companies personally, and they still can't pick stocks consistently to beat the market. Even Warren Buffett, the greatest investor of probably all time, in the last sort of like 10, I think the last 10 years, has literally, I think he's like essentially done the same as the S&P 500. So it's still, I mean, still pretty amazing he's done that, to be honest with you.
Yeah.
But he's like the absolute GOAT. And if the GOAT is struggling, like, what chance do we have, who are sort of working a job, going on a night out? So I think people think that investing in individual stocks is sexy because you can essentially make like 200% in a year or whatever. But the thing is, that's not really going to build you wealth. And I think the problem is with investing into individual stocks, as you mentioned, it is probably mainly luck, really, because most people who invest in individual stocks are not reading the financial statements for the last few years. They're not listening to the shareholder calls. They're not doing due diligence. They're not looking at industry trends. They're not looking at competitors. They're not doing any analysis. They just see a company they like and invest into it. Don't get me wrong. That's better than, like, I guess, saving your money or like keeping it in the bank account and earning nothing, or just blowing it all at the weekend. But I guess you want to have like a sort of more sensible, easier way to sort of slowly build and compound your wealth over time. I think you cannot really beat index funds, to be honest with you. It's just almost like property, right? Like buy to let. Investing into property using buy to let is a proven strategy. It's worked for decades. It's made so many people millionaires. It's not it's not like a sexy HMO or a lease option or a rent to rent or service accommodation. Of course, all these strategies can make you more money, but there's more work involved, it's more risky, and it's the same with index funds. You can pick stocks, you can like trade futures, use margins, use options, but at the same time, it's a lot more work, and you know you have more chance of essentially losing wealth rather than building wealth. I guess what I sort of try and promote through my like channel is like sort of like the easy and simple way to build wealth, so you can I guess like have free time and have fun rather than like constantly researching companies.
Index funds, spend your time. It's like it's a cost benefit analysis technically,
because if you beat the S&P 500, right, by say the S&P gives 10% and you get 15%, but then you've spent like 500 hours over the year, like 2 hours a day, you've lost out massively, because that 2 hours of your time you could have been doing so much more stuff with. You could be generating more
income and putting it back into index fund. It's true. It's very true. It's
the thing is, I don't
cost benefit.
I don't want to come across as like I'm hating on other strategies or like people that do pick stocks, because I do have, I think for my stock market investments, I think I'm about like 96 or 97% index funds. So there's very few individual stocks, but I do get it is fun to invest in individual stocks. If you believe in the company, it is great through the stock market. You can invest into them. But I would just say, as a rule of thumb, try and keep the backbone of your portfolio in index funds. Then you'll sort of slowly compounding your wealth over time. And then with like maybe a little bit on the side, use that to sort of pick stocks and have a punt. But don't want to come across and hating on investing. But I do prefer passive investing and index funds. That's what I do personally.
It's a good argument, and I think it's good for people to understand what the different options that they have out there, so that they're well informed, so that when they're making decisions, they can make a decision that's best for them. I'd rather people understand that there's another, because some people don't even know that investing existed. I didn't know investing existed 10 years ago, personally. There was
when
a
I
way
first
to invest in
started,
stock market.
When I first started, I only thought that was individual stocks. I didn't know what an index fund was. So I put money into individual stocks. And then I'm like, obviously done some research, and I realised, okay, index funds are the way to go. But that's one of the things. Hopefully, by us talking about it now, people can then like help them get started. And if they're not using index funds, they can then maybe reevaluate whether it's better to use index funds going forward.
Exactly. So out of interest, what are you actually invested into? What index funds do you have yourself in your portfolio?
My main one is the FTSE Global All Cap.
Okay.
So There's so much I can say about this. There's like a huge section on this in the book you mentioned at the start. Stop waiting, start investing. But essentially, when it comes to picking another problem is, right, you want to get started investing. You're like, okay, cool. There's a lot of stuff to learn. You want to now choose an index fund. It's like, okay, cool. There's loads of index funds.
Lots.
So what do I do? I do like even in the UK, you got the FTSE 100, FTSE 250, FTSE All Share. You then got the US as like the NASDAQ, the S&P 500, Dow Jones. There's global ones, there's emerging market ones, there's Japanese ones, there's European ones. My approach really is just have most of my money in one global index fund, because through one fund, you get global diversification. So this particular fund has over 7,000 stocks in the one fund. So it's pretty much as diversified as you can get. It's a Vanguard fund. That's why I have my stocks and shares ISA with. But I think people think that they need to be doing more. Like they need to be like, even with index funds, like I need to have one index fund for the US, then one for emerging markets, and one. But like you don't. If you have one global index fund, you're getting as much diversification as you need. And actually, I sort of through the book, I go through loads of data. By investing globally, you're actually getting, over the long term, you'll get higher returns for lower risk. The reason why is because the same two countries are never the best performing country and the worst performing country in decades. So if the US is the best, so the US has been the best performing country over the 2010s, but relatively speaking to the global stock market, it performed awfully in the 2000s because of the dot-com crash and then the financial crash. So, if you obviously were only investing in the US from 2010 onwards, you would have beaten a global stock market fund. But if you'd done that 10 years previously, you wouldn't have. And I thought there's a lot of emphasis on US funds particularly, and also UK funds. We can get into that. I don't like UK funds at all. With US funds, a lot of people, I get so many questions like, should I use an S&P 500 fund or a global fund, or like a total US stock market fund or a global fund? And my response is always, like, it's up to you. But personally, the US has had multiple decades in the 1900s and also a decade like the 2000s where it underperformed, relatively speaking. So in my point of view, if I'm going to be investing for 40, 50, 60 years, one day living off my investments, I'm not going to be naive and say I know which country is going to perform the best. Japan, is a brilliant example. Japan, in I think the 80s or 90s, was the best economy in the world. It was the most efficient economy, most productive. It made up 45% of the global stock market, right? So people thought Japan is the future. Now it only makes up 8% of the global stock market.
Yeah. Okay.
So relatively speaking, it is literally shrunk by like 90% compared to other economies like that have grown in size over that time. So when people say like, should I use a US fund? I'm like, well, think about those people who would have only put their money in a Japanese fund 30, 40 years ago. And now look where they are. And that's essentially, the risk. I don't want to bet on one country. Because also, a lot of people then have an argument. Sorry, going down a bit of a rabbit hole here. A lot of people have an argument that, the US makes a lot of their revenue from overseas. And it is true. US companies do make about 40% of their, like the S&P 500, 40% of revenues come from overseas. So it is sort of globally diversified in that sense. But at the end of the day, they're all still listed in the US. There's political risk from the government. There's currency risk from the US dollar, which is being devalued like crazy compared to other currencies because of all the money printing, because of like, I guess like all the pandemic and everything. So it's sort of, you can maybe like adopt a hybrid approach where you could use like a global fund and a US fund. But me personally, literally all of my money in my stocks and shares ISA is in the FTSE Global All Cap. I've been dollar cost averaging, so investing monthly into that fund now for over 3 years. And I think on my total, I've got like a spreadsheet, but I think my total of my entire stock market investments, I think that one fund is about 85% of my total money. So most of my like investment net worth is in that one fund. And it just comes back to being globally diversified and I'm sort of accepting that I can't beat the market. And because I can't beat the market, I'm going to use an index fund. And secondly, I don't know which country is going to perform best, so I'll just use one global fund rather than trying to bet on different countries and sectors.
Yeah.
So that's a very long-winded answer. But essentially, I go into a lot of detail that in the book, but yes, like loads of data and stuff to just sort of support why global diversification, whilst it's never normally the best performer in a given decade, over the long term, relatively speaking, it usually does well just because some countries will perform poorly in some decades and then amazingly in other decades, and no one knows ahead of time which those countries are going to be, which is why by using the global index fund, of course it's not once again as sexy as like individual stocks or individual countries, but if you're trying to invest to build your wealth, it's a very simple way to do it and an easy way to go, and you're not really taking any chances. The only way that can literally fail is if there's literally like a zombie apocalypse or Earth, or like a nuclear war where there's just no more companies on Earth.
Yeah. I completely agree with you. And
so yeah,
that makes sense.
Had, though, on like global versus US, there's a frequent like debate on that. People message me almost on a daily basis asking about that. Luckily now I'm like, just read the book because it's all in there. But it's just like there's so many things you can go down. And the thing is, investing in the US, there's lower fees. Obviously, it has been better returns the last 10 years. But obviously, you want to have a long-term mindset. Past performance doesn't mean the same is going to happen. So yeah, I'd say that's probably my thoughts on why it's a global index fund. And also, as I mentioned, I sort of don't really use individual stocks, invest into them, just because I think index funds are the way to go. And then I don't know which country is going to do best. So a global index fund is the way to go. And also, above all, by having like just one fund, it makes my approach incredibly simple. I automate my investments every month. It's very passive. It's hands off. As I was saying to you before this call, I've been very busy in October, and my index fund investment is still going through every single month without me doing anything, without me doing any research, and that's how I want it to be set up, essentially.
Yeah. You said a lot, and I agree with a lot of it. I agree with a lot of it. I
that
think,
was a lot.
No, it's fair enough. I agree a lot of it. I think the interesting thing about the US, I think, is because that's where most of the sexy companies are. Your Apples, your Teslas, your Microsoft. That it's known, right, the US. But you're completely right, because if you're getting an index fund that's literally focused just on the US, you could miss the rest of the world, right? You can miss the rest of the world, and the US may no longer grow in the future. It might be the 5th largest economy or the 10th largest economy. Yeah. Nobody knows. So
it's really interesting as well. Like this sort of graph that I found is where essentially the US, right, 100 years ago made up about 25. I think it was 25% of the global stock market. Oh no, it was 15%. Sorry. Then a few decades later, it was up to about 65. Then it went down to 25 in the 90s, and now it's back up to 55, 58, around there. So in that 100-year period, it's fluctuated between 15 and 65. So you can sort of see how, obviously I know a century is a long time, but realistically, if you're in your 20s or 30s, you're probably going to be living for at least 40 or 50 years. So just imagine like betting on sort of one country or one company, and over that period, it doesn't perform like it did the last 50 years, then you're essentially stitching yourself up a bit.
Exactly. And that's the thing. And I understand a global fund. I got a global fund as well. For the exact same reasons, because I wanted to capture everything. I don't know. Obviously, everybody knows America might do well, but you want to get places in Europe, you want to get places in South America, you want to get places in Africa as well. So I also invest in a global fund. And I completely agree with you. It's all about simplicity, and that's what works for you.
Exactly.
So talking about like your return, what's actually like the size of your portfolio now? I know that you're quite transparent with it on social media, but so what's the size of it at the moment?
So it's over 40k now in total. So I did a post on that last week. It's probably, to be honest with you, different topic, but now Bitcoin's at all-time highs and stuff. It's probably more than that, just because I've been investing into crypto for like weekly pretty much for well over 18 months now. So that is probably maybe up to 43 or 44k. I'll just say 40k for simplicity. It was 40k about a week or two ago anyway. And so I think most of that, I've got about a third in, I think it's about 15 or 16k in my stocks and shares ISA, which is all in that one fund, the FTSE Global All Cap. I then got another about a third of that, probably about 10k in a workplace pension, which is also all just in one global fund. I don't have the same options, there's limited options because where I work and in accounting and stuff, but essentially I chose the lowest fee global fund, and then the other sort of like 10k is then in sort of crypto, and I've then got like a couple of k in individual. I've got like maybe like 1k max in individual stocks. It's like about 3% of my portfolio individual stocks. So most of it really, and in the accounts that matter, my workplace pension and my stocks and shares ISA. All of that is just one global index fund in each. So I'm practicing what I'm preaching here.
Yeah, that's
I'm
good.
Just saying this and then like betting like on Tesla, 100 Tesla.
That's the thing. Yeah, Tesla's another thing. Tesla it can't be beaten right now. It's doing all the right things. We'll go there with Tesla. I mean, I can't believe the valuation, but I'm not gonna say anything. Oh, wow, that's fantastic. Really, really well done. And over what time period has it grown to that?
That has been, I guess technically it's been about 4 years now.
Okay, that's good. Yeah.
But that first year though, I'm actually posting this as well recently as well. So that first year was just my workplace pension, and I'd less than over the course of the whole year because I was making the minimum investment. I had less than the grand in there. So really, it was probably the last 3 years when it's probably about, I think it was like August 2018, around then, probably just over 3 years ago now, was when I actually set up a stocks and shares ISA and started with £100 a month. I was still at uni then, but now obviously it's now like £500 a month, and obviously invest in my side hustle income and other stuff. So now like the last couple of months, I've been able to invest like 4 figures per month. So that's like 1 month I'm investing now, what I had in my whole first year of investing, which is why I always sort of say like just start small with what you can, and then over time you can build it up as you like your salary increases at work, as you have a side hustle and get other income streams. But yeah, I'd say most of that has really been over 3 years, ever since I started investing into the FTSE Global All Cap inside of my stocks and shares ISA.
Yeah, fantastic. And it's interesting that you said start small, because I think that's the way to do it. A lot of people think, let me wait, let me accumulate money, and then let me invest, rather than the other way around. Actually, I've got £1. Okay, £1's not a lot. Let me just put that in. I've got £10. Let me put £10 in. I've got £100. Let me put £100 in. Let me put.
I
50.
completely agree. Yeah.
Do you know what I mean? Like starting off really small.
Wait till the new job happens. Wait till the promotion. Wait till like Christmas is over. Wait till this and that. But then just start even like I mean, Vanguard, the minimum's £100. A lot of other these investing apps, it's like a £1 minimum. You can just chuck in like a tenner when you can, and then you'll start slowly getting addicted and want to invest more and more, and that's the beauty of it.
Exactly. Yeah. I think it's just very important just to get started now, because you want to use that time to increase your investment. You want as much time as possible to increase your investment over a very long period. That's the whole point of it, right? And it also gets you into the habit. I think starting also gets you into a habit of doing stuff with a direct debit. You've got that money coming from one account to your investment account every month, and it's like sort of like part of a ritual at times. And if you can automate
that as well, that's even better. That's what I preach that as a lot as well, about automating it, because then you can make it more hands off. It's just easier to do, and you know it's coming out. Then you almost like make cutbacks to sort of make it fit in, because you know that investment's coming out no matter what. So if you can automate it as well, that's even better. It's
so important. So moving into like beginners getting invested into an index fund. How can a beginner get started to invest in an index fund?
Yes, you really need 3 things, and this is something I also regularly post about on Instagram. The first thing is an account. So you need like an investment platform. You need somewhere where you're going to invest. So Vanguard, Free Trade, Fidelity, Wealthify. There's loads of platforms really. I always say when choosing the platform, you always want to start with the end in mind. So you want to see think about what you want to invest into, and then try and work back and see if your platform offers that. So with Vanguard, for example, they have the FTSE Global All Cap, which I invest into. So I use that, but they don't offer individual stocks. So if you want to invest in individual stocks as well, it's not going to be the best platform for you. Something like Free Trade or Trading 212 might be better for that. But the first thing is an account, preferably a low fee platform. A lot of the platforms nowadays are low fee or zero commission, so that's almost like a given now, which is good. Whereas obviously years ago, it was a rip off to invest.
It was a literally rip off.
The second thing you then need is an account. So an account would be like a pension, a stocks and shares ISA, or a general investment account. They're the 3 main types of accounts in the UK. Generally speaking, you probably want to be using the stocks and shares ISA. This step 2 is a bit more sort of, it depends on like your salary, your age, what you want to do. But I think as a default, just go over stocks and shares ISA is probably the easiest thing to do. And then number 3, you then actually, I guess, choose your index fund that you want. So me personally, I'll use a global one, but people might want to use a US one, might want to use one from a part of the country. You haven't got to just use one. You can use multiple as well. But yeah, that's essentially the 3-step process to get started. And yeah, that's what I'd say on that.
Awesome. Thank you. And what would you say is the rate of return that a beginner can expect from their money if they were investing in an index fund? Let's say a global index fund, a similar one to you.
So it should be about 8% after inflation over the long term.
Okay.
But I think this is, once again, a bit of a misconception, because people are most familiar with like cash ISAs and savings accounts where you get like 0.5% or 2% and it's guaranteed. With investing, no matter what it is, property, crypto, stocks, it's not guaranteed. It's essentially whatever you invest into is what you're going to get. And I think people there's a big misconception. People will say like, what return can I get from a pension? But it's not the investment is what's inside of the pension. The pension or the stocks and shares ISA is just the account, and essentially whatever you put inside of that account is then what generates you your return. So it's not your pension or your stocks and shares ISA, that's just like the wrapper or the account. So whatever you then put inside of it is then what generates your return. But I mean, yeah, I'd say if you look at like sort of past data and history with investing, if you're using like a diversified index fund, you usually get around 10% before inflation. Then if inflation is 2 or 3% over the long term, you probably get around 7 or 8% over the long term. But it's very, very rare to be 7 or 8% in a given year. Like in my index fund, the FTSE Global All Cap, I think the first 2 years I was in it, it was about 3%, then about 4%. And in the last year, it's been like 27%. So it sort of averages out over time. Obviously, there will be some years where there's a crash and it'll be negative. But the most important thing is you have to stay invested and obviously keep like investing every single month. But yeah, I'd say yes, like sort of maybe like middle to high single figures. I actually have a sort of compounding projection spreadsheet, so you can compound it at like lower rates return, like 5%. But I normally use 7 or 8% when I make my own calculations, just because that's sort of after inflation and it's fairly accurate of history and data.
Yeah. And I like what you said about, investing is not guaranteed. This is not financial. This is not financial advice. Yeah. Just saying it's not financial advice. This is just purely for informational purposes only. But yeah, you said something important. I think a lot of people with investing in any asset type, and you stated it, property, crypto, stock market, all of them have had crashes. Yeah. Nothing is safe.
And they will crash over and over again.
Yeah, and I just don't understand why people can't just accept that's just reality of it. That's just life. There's just some things that, we don't, unfortunately, we don't live in a utopia, and, crashes have to happen because actually crashes happen because of being in a utopia. That's why the crash happens, because we get into utopia and then people become reckless. We overspend. We leverage more than we need, so we can't afford. And that's why the crashes happen. The crashes happen to bring us back to earth, to be like, actually, we need to tighten our belts a bit more. That's why crashes happen. Sorry. No, go ahead.
No, I was like, 2 things to say on this, right? The first one is, crashes are literally the best time to buy, but it's when most people sell. Yeah. So and this is why automation's so good. I promise you, I don't even know when Bitcoin crashed the other week. I didn't know when it was all-time high. I didn't know. There's only people DM me and are like, "Have you seen this?" That I actually realised. But I really just try to ignore the noise constantly. But when when it crashed 30% in March 2020 because of COVID, I was still investing automatically. It's now at all-time highs. I'm still investing automatically. The price is literally irrelevant. I'm just focusing on investing automatically, and that's why it's so good automating your investment, because when the market does crash, your investment's coming out automatically. You're not going to get scared of that money going in. And secondly, sorry to keep plugging this, but this is something I go into detail as well in the new book. But there's like crashes and corrections, right, are very, very common. Like on average, there's a crash so a crash is more than, I think, 20% and a correction is more than 10%. With a crash, it on average happens every 7 years, and a correction happens on average every 12 to 18 months. So if you're 20, by the time you technically retire, you would have been through probably 40, 45 corrections and maybe 5 to 10 sort of stock market crashes. So these things are very, very common. They happen all the time. They've always happened in any market, even like art, Pokemon cards, crypto, stocks. All markets crash, right? And this is why it comes back to that financial education and understanding like it's normal, not panicking when it happens. And if anything, maybe try and invest a little bit more. If the stock market's down 10% that month, I'm like, you know what? I might try and save £100 on my budget and check an extra 100 quid in.
Exactly.
But another key point as well, just when we're talking about returns, like I literally do not care less about my rate of return, because relatively speaking, right? So I've got 40 grand invested now. Even make 10% on that, like it's 4 grand, which is a decent amount of money, but it's not life changing. Imagine if I had like 400 grand invested, then 10% is 40k. If I had £4 million invested, then all of a sudden I'm getting 400k and living like an absolute king. So I think the most important thing people really need to focus on is actually just their contributions. If you can focus on investing as much as possible for increasing your salary, invest as much as possible through creating other income streams for like a side hustle or something on the side, then really just contribute as much as you can today, because it's almost about building up your pot to, obviously there will be some gains and stuff that come with that, but it's about building up that pot to a point where you can live off of it. And even at 100k, 10% is only 10 grand, but $1 million, 10% is 100k,
100K,
and that's like
yeah.
triple the average salary. And I know it's
Yeah.
hard to get to that point, but it's really focusing on contributions and not obsessing about the rate of return is and how you get to
Yeah.
that point.
Yeah, I completely agree. It's about you get more. The more you put in, the more you're gonna get out of it. So
Yeah.
it's about, like you said, increasing your contribution.
Another a lot
as much
of
as
things that
you
people don't realize as well is by investing you're getting dividends. People
Yeah.
only really seem to look at the gain. So just say if you
Yeah.
made 6% this year, you might be like, oh well, that's not great. I should have been 8%. But if you're like I think my global fund, the dividend yield's quite low on global funds. To be fair, it's only about 1.3%. But that 1.3%, even if like the price has gone down or up, that's still more than like any savings account on the market. And that's just me by essentially investing, getting those dividends. And then as well, a key point here is if you invest into index funds, try and use accumulation index funds because accumulation funds reinvest all of the dividends. So without even realizing it and lifting the finger, all of your dividends are then being reinvested to buy you more shares in the fund. And then over time, that's going to snowball your wealth as well as the appreciation of the fund over time, hopefully.
Love that. Great explanation. Really like that. So we delved into it a little bit, but what should beginners look for when they're looking for an index fund to invest in? So you mentioned the global, but is there any specific things that they need to look at? Fees, countries that they're investing in, anything like that?
I think the main thing is fees, and I get quite a few questions on this as well. But if you go on an investing platform like Free Trade or Trading 212 that offer thousands of funds, so I guess ETFs are sort of, I won't get too much into it, but ETFs are essentially the same as index funds. There are some differences, but if you have an S&P 500 index fund and an S&P 500 ETF, they are both aiming to do the same thing, which is passively tracking the largest 500 companies in the US. There are some differences between the two. There are different ways to invest, but they're essentially trying to do the same thing. The most important thing really in that case is then fees. So if you go onto your investing app and type in S&P 500, you'll probably get loads. There's like a Vanguard version, an iShares version.
Yeah.
There's like 4 or 5 versions, I think.
Yeah.
So the most important thing really is to look. They're all trying to do the exact same thing. So the most important thing really is to just choose the lowest fee one. Essentially, the lower the fee you pay, the more money you have compounded in your pocket, and then the more money you end up with in the end. And that is really the big reason why index funds outperform most active funds, because active funds have managers actively picking stocks to beat the market, and they can charge really anywhere from like 0.5% up to like 2 or 3%. Some of the fees are pretty crazy, and it doesn't sound like a lot. Like 1% doesn't sound like a lot, but I've sort of run the numbers on this, and if you're investing consistently, you can literally lose like 1/3 of your potential investment returns because it's going to that fee. If you even go into a compound interest calculator, put in £100 a month for 30 years at 10%, change that then to 8% for that extra 2% fee, and all of a sudden you get significantly less amount of money. So I'd say fees is probably the most important thing to look into. And I think also you need to think about, I guess, how active you want to be in choosing your investments, because it's always, even though index funds are passive, you still need to sort of choose that index fund, and that is an active decision. So I've actively made the decision to keep my sort of portfolio as simple as possible through one global index fund. I take more risk really on crypto, which is about 25% of my total portfolio, but my stock market portfolio, it's literally just mainly in index funds, because I believe you can't beat the market, and I've taken that decision. People could, as we mentioned, if you believe in the US or China or emerging markets, you can allocate extra money to those things. You probably want to think about where you think the world's going to go and what you want to invest into. But me personally, I'm just like, lowest fee global fund I can find, stick to that, job done.
Okay, awesome, fantastic answer, thank you.
And then I guess me personally, I'd rather take more like risk with crypto, or one day if I got into property investing, because I believe with those sorts of things it's probably easier to make abnormal returns if you're sort of skilled. Whereas with the stock market, just because there's so much data and history has showed time and time again, it's really difficult to consistently beat the market. Which is why I really limit my individual stocks that I have.
Yeah. I love that.
Yeah, sorry,
you
mentioned... a lot of information for people listening.
They can re-listen to it again, and hopefully, obviously, if you've got any questions, please feel free to DM either myself or Ryan. If you
anytime.
We try to distill and break down the jargon as much as possible. And to be fair, I feel like Ryan's been super clear, but I do understand that for investing for a lot of people, it's a new area. But I promise you, take it slowly. Read a few books here and there, watch a few videos, listen to a few podcasts, and over time, you'll get it. You're not supposed to get it within a few days. I wouldn't say that's your aim. Try and get it over a number of time. Again, start very easy. Start with an index fund. Start with a global one. Make it very easy. Automate it, and then just learn about finance. Personal finance generally, and that's what I did. That's literally what I did, and that's what worked for me.
I couldn't agree more. I was going to say, literally everyone that people follow, like us, who has finance accounts, were also clueless at one point.
Exactly.
And it's only really from reading. Yeah, it's only really from like reading and watching and listening to then. Now we are trying to like help other people sort of do the same.
Exactly.
Yeah, everyone's clueless at one point. Just get started with 100 quid, and then, as you said, learn and tweak as you go. You may start with an index fund and realize, this is boring, because it is pretty boring. You haven't got to do anything. Then you may want to maybe have 20% of money in individual stocks that you can then read their accounts every quarter and listen to their shareholder calls. You might find it interesting, or you might be like, well, you know what, this is pretty boring, but I can have more free time rather than sort of fiddling around with all my investments. Then I will stick with this strategy. So just got to get started and then find out for yourself what's the best way to go.
Yeah. Fantastic. So you mentioned a few investing platforms: Vanguard, Trading 212, Free Trade. Are there any other investing platforms that you think are good?
There are quite a few good. I personally just like Vanguard the most. So my stocks and shares ISA with them. I think you can actually lower your fees by using the zero commission platform like Trading 212, Free Trade, Stake. But I think Vanguard, second largest asset manager in the world, they've only invested into index funds and ETFs. So there's no individual stocks. I'm not going to get sort of dragged into any of that. Like Jack Bogle, the founder, was the person that actually created the index fund, and Vanguard are actually owned by their funds, and that means they're owned by their shareholders. So if you invest into Vanguard, you are a Vanguard shareholder. They're not like other companies like BlackRock or Fidelity, where they're listed on the stock market and they're trying to please shareholders and they're trying to cut costs and make profits and all that. Vanguard literally can charge such low fees because they're essentially, they're not like a public company trying to get up in the rankings and make profits. Of course they do. I imagine they do make a lot of money still, but they're just sort of out to help people start investing for the average person, and they do that through offering low range of funds. Their customer support's always been good whenever I've chatted to them. They have that global index fund that I mentioned. So I personally, my favorite account is Vanguard, and my most important account is my stocks and shares ISA, which is why I have that with them.
Okay, awesome. Thank you.
Yeah, that was give a specific answer on that one. Essentially, my main strategy is like Vanguard for the platform, stocks and shares ISA for the account, and then FTSE Global All Cap for the fund. So that's the three-step process, and that's what I do personally. Obviously, not financial advice, but just sharing what I do personally in case it helps anyone.
Yeah, and people like to know what others do and how they grow their wealth, because when I remember when I was starting, I didn't have anybody that I could speak to. I didn't have anybody that I could look towards and be like, what are you doing? Like, how do you do this? I remember having to read through the Morningstar, read through Fidelity, read through all these websites to understand, okay, how do I invest? Purely for fun. How do you invest? Okay, you need to find a platform. Then you need to think about platform fees. Then you need to think about fund fees. I'm like, what is all of this stuff? And then I need to think about what the fund is. But I didn't have anybody that could be like, okay, what's a good fund? What are you investing in, right? And now we do that. We now have those people. So I think it's always interesting to, even if they're not going to go with it, they know that it's working for somebody else and somebody's using that to grow their wealth. So are there some mistakes from beginners that you think that are like, you just think of it and you're like, these are not great mistakes?
So you know what, I can go through my mistakes, because I also talk about this in the book. I made 5 big mistakes pretty much in my first month of investing. So the first one was I bought an individual stock. So this is obviously before what I knew index funds were. I bought it for I think about £400, which was quite a lot of money at the time, because I sort of worked for a bit for that year in placement. I had some money saved up. But on that, I paid a £12.50 trading fee and an FX fee. So the percentage, it came to like 3 or 4%. Then I had to pay both of them when I then sold the stock as well. So I paid huge trading fees. Now we're talking about free trade on Trading 212 of like 0% like platforms. So I'm paying like 3-4% on that, which is just crazy. That was my first mistake. I also made that investment outside of a stocks and shares ISA, which was another mistake. Realistically, as we said, you want to try and be using your stocks and shares ISA or your pension. I won't get into sort of the tax things now, but essentially they have tax benefits. The alternative is using a general investment account, which is your standard investment account, and that has no tax benefit. So, you pay tax before you contribute, you then pay tax when you sell. Obviously, there's like allowances and you can get around it, but essentially by using a stocks and shares ISA or a pension, you're getting tax benefits. So that was my second mistake, not using one of those. My third mistake was I then did open up a stocks and shares ISA, but it was with my bank. So I thought you could only open up an ISA with a bank. I didn't realize there was, and banks are probably like the worst people to have a stocks and shares ISA with. They offer even their like cash ISAs are the worst rates. Luckily now, once again, there's loads of traditional like brokerages like Vanguard, Hargreaves Lansdown, Fidelity. There's also now loads of like newer zero commission brokers like Trading 212, Free Trade, Stake. So there's now a lot more essentially options to essentially pay lower fees. So yeah, there are 3 mistakes that come to mind. There were more that I made in my first few months. Oh yeah, also my first stock I bought it based on a tip from this guy on YouTube. So never want to invest into a stock based on a tip. You want to do your own research, understand what the company is. So yeah, there were 4 beginner mistakes really. So using the general investment account, paying high trading fees, investing based on a tip. And yeah, essentially when I did choose to open up my stocks and shares ISA, using it in my bank and not actually researching, I could literally just Googled best stocks and shares ISAs and there's loads of blog articles and I could have got more of an idea. But yeah, I was obviously clueless back then. And now obviously trying to help people prevent those same mistakes. Another one I'd probably chuck in there as well is checking your portfolio like too often on a daily basis. I feel like everyone's been there, especially when you start. It's quite exciting. But really, I think the famous quote goes, investing should be like watching paint dry or like grass grow. It's very boring, very slow process. It's all about time and compound interest. They then build your wealth. So yeah, checking your investment app often or your portfolio is more likely going to drag you into buying and selling regularly, buying and selling based on emotion. And that's something you never want to do as an investor. You want to try and be as sort of hands-off and as rational as possible, rather than just sort of like seeing some news, panicking and selling. So yeah, there are a few that I made myself, 5 mistakes I made myself, which hopefully other beginners hopefully other beginners can avoid. But I reckon a lot of people also made similar mistakes when they first got started.
Yeah, love that. Those are some interesting mistakes, and I feel like I can definitely sympathize with you on some of those mistakes. I made similar mistakes, and the bank one is a very interesting one because I think for banks, for banks when they're going to their banks, it's so much more convenient for them. It's like when they see something that is new to them, a new topic, instead of them having to go out and read, they feel like let's take the easiest path, which for them is let me just contact my bank and get stocks and shares ISA, which you're saying like they're charging ridiculous fees. They're offering the same funds that you can get on 0% platforms or actually directly on those platforms. So Vanguard, you can get directly on Vanguard, but your bank is getting the extra fee on top. Literally, that's how they're making their money.
It's the same as getting a mortgage. People go to a bank because they think it's like safe getting it from a bank, but it's not, because you're literally losing like a lot more money than you should be.
Exactly.
So yeah, it's one like if you get an independent mortgage broker, you'll get a better mortgage rate rather than going straight to the bank. And it's the same as sort of doing this. Do your own research, find a low fee platform. You'll then save yourself a fortune over the long term, rather than just sort of being ignorant and going to the bank.
Yeah, exactly. Yeah. So finally, for this section, what can a beginner do to increase their chances of growing their investments?
I think really just getting started, to be honest with you. I think with investing, the earlier you start, the less you can invest and the more you can end up with. And I've done some, I can't remember off the top of my head, but I've done some calculations where even if you start investing when you're 20 and stop investing when you're 30, you will end up with more money than someone who then starts at 40 and invests triple the amount that you were investing per month. And that is because you're essentially getting that compound interest over that, say, time period up until when you retire when you're 65. So yeah, I'd probably just say you just got to get started really, because then you get more compound interest. And compound interest is a very misunderstood topic as well. People don't really get it. But all that is essentially interest on interest, or essentially return on return. So if you earn 10% this year, you leave that money invested, you earn 10% next year. That sort of first year 10% return is then earning another 10%, which once again doesn't really do anything in the first few years. It doesn't really matter. But as I was talking about, over the long term, when you build up to like 100k, £1 million, and more, that's when even like a 5% return is all of a sudden like 50k, and that's like double the average salary nearly, and you can live off of that rather than working a 9 to 5. So I would say the best chance you got is just getting started early, and also by starting early, as I said, you can invest less and end up with more, but also you can also ride out any crashes and corrections. As we mentioned, they happen very often. So by investing regularly is actually a good thing if the market crashes. Like, I actually wish the market would crash like 70%. I would love it, because I would just invest as much as I can, and I know in 10 years' time when the market's like doubled again, it would have been a great time to invest.
Yeah.
So because I guess it's a bit difficult, because with that question, if it was like individual stocks, it's probably easy to like look at the PE ratio, look at this, look at that. But with index funds, I think it's really just about getting started, contributing what you can, and essentially like trusting the process, staying the course, staying invested, and letting time and compound interest grow your wealth over the long term.
Yeah. I completely agree. I think it's about starting as soon as possible, like you said, because you want to get those gains. And even if you start with a small amount and, you know, pick it up, that is definitely the best thing. I think when I started, even though I didn't know what I was doing, I didn't invest more than I could. I was like, okay, you know what? Let me just try and put £100 a month. I'm comfortable putting £100 a month, right? And if I lose it, if I lose my investment, then it's fine. Like, I'm only putting in £100 a month, which is not going to break the bank for me. And that's how I started. And after, when I became more and more confident, I just started increasing it monthly. So I think it's best to try and start with little amounts, £50, £100, whatever comfortable with yourself, and then just grow over time as you become more confident in your strategy and
Completely
your process.
Great advice.
Great. Thank you. So we're moving to the last segment of today's podcast episode. So it's a Finfluencer quiz. So anytime I interview my fellow Finfluencers, I've got a few questions I want to ask them. So the first one, so it's like a would you rather. So the first question is, would you rather have a lot of money and no free time, or lots of free time and very little money?
I'd probably say lots of money and lots of free time.
It's not. Yeah, in your reality, you might be able to do that, but in this reality,
I don't know, to be honest with you, because I'll probably say the free time one. But then, if you have loads of free time and then no money, you can't
very little money. Yeah,
you can't really do anything. Obviously, you can spend time with family and friends, but you can't really explore the world or travel or buy stuff you like. So. But then at the same time, if you had loads of money and no free time, then it's almost the opposite. You can buy anything you want, but then you can't really, you once again probably can't really do any traveling or spending time with family and friends, because you're just like working the whole time. If I had to choose, I'd probably say the free time one.
Okay.
And little money. And then I'd then use that free time to start a side hustle and start making some more money.
Yeah. That is it. That is literally it. You just have to build it up and just make sure that you put yourself in a position where you still have that time remaining.
That's a tough question though, because they're both good, but they're both bad. So there's not really a good answer there.
Exactly, yeah. And I think this is a lot of people's reality right now. You know, they are going, they're going up the earnings career ladder, and I think that this can happen in any, whether you're entrepreneur or career. If you're not very deliberate about, you know, imagine you made money, but you just spent it. You never invested it, right? Whether it's through a business or a career, income is income. It's just dependent on how you generate that. Not really generate, but how you spend your income, what you do with your income to buy back your time. That's how I see it. You use your income to buy back your time, no matter how you generate it, right? If you were an entrepreneur, and even if you're making $1 million and you're spending $1 million in a year, because some people can do that, right? You're actually not becoming more free, right? You're just always working for $1 million and then spending $1 million, right? It's no different to somebody who's in a 9 to 5 and they're getting 40k and they're spending their 40k, or they're not spending their 40k, but they invested 10k a year, but over 10 to 15 years, they're like, okay, now I bought back my 40k a year. I can now live off that, right? So I think it's how you manage your
financial freedom.
Exactly. Yeah. Yeah, a lot of people get bogged down on the paths when it's not that. It's actually the income, how you manage the income when you get it, what you do with it. Yeah. Do you buy your time or do you not buy your time? That's how it is. Yeah.
And that's why it's so important to pay yourself first. Even if it's
Yeah.
like start 10% of your monthly salary,
Yeah.
just even that is better than nothing. And then over time, you'll get addicted. You'll want to invest more and more. And then hopefully, you'll end up being financially free before that person who earns $1 million but spends $1 million and that's still grinding 50 hours a week just to then spend all their money, rather than the person who's actually invested and becomes financially and time free.
Exactly. Thank you for that. Thanks for that answer. So the final question in this segment is: would you rather have £1,000 a day for the rest of your life, or have £1 million in the bank today?
Oh, it's got to be £1,000 a day.
Yeah.
Definitely.
Yeah. In 3
That's-
years,
yeah.
in 3-4 years, you'll get your million.
Yeah, it is tough though, because I guess, it's tough because I reckon like, because if you had £1 million a day, I reckon like if you was like a very good entrepreneur, you could probably turn that into like a huge amount of money in like a space of a year, and probably outgrow that grand a day. But I think by getting a grand a day, that's just like perpetual passive income. And then as you say, after a few years, you'll get to the million. And I guess that really is sort of what you want for investing. You know, if you're investing into an index fund, if you can get to the point where, you know, every month you're getting like, even if you're getting like £2,000 a month from your index fund from dividends, you can then essentially just if that's like less than your expenses, you are then financially free. So I'd probably say the £1,000 a day, to be honest with you. I don't trust myself to double that £1 million quick enough.
It's tough, right? Like if you got the 1 million, like, oh, am I tempted to spend it on something else?
That's the thing as well. I think if you've got the 1 million, the thing is 1 million, right, is a lot of money. But if you're going to be living for 50 years, you're going to have a family and all of that, you will get through all of that. I don't know what the average like cost of one human would be over their whole lifetime. But I imagine it's probably, if you get like a house, a car, trying to go on holiday, like you go family and friends, it probably must be somewhere around that, maybe more. So I reckon by £1,000 a day, you're probably less likely to do something stupid with it. Whereas the 1 million, you might just go and blow like 250 on a Lambo, then you're down to 750. Whereas £1,000 a day, you're less likely to do that because it starts off smaller. And in that meantime, you can read books on financial education, then you know to invest it.
Exactly. Yeah, no, I completely agree. I'll go to 1,000 a day, and I'll just invest it in passive and just do other things on the side.
That would be so good.
That would be really good. I mean, you know, our trajectory is we'll probably get to a point like that if we keep on working on that, and hopefully the listeners too, if that's what they're working towards. Obviously everybody has like different goals and what they want to do. Thank you so much, Ryan, for, you know, blessing our podcast and dropping so many gems. This is why I call you the Index Fund King. I'm gonna give you that name. I mean, you should give yourself that name in the future, Index Fund King. No, thank you so much. What have you got planned next for Making Money Simple?
Yeah, I'm not too sure, to be honest with you. It's a good question. So I've released my new ebook, Stop Waiting, Start Investing, a few weeks ago, and then since then I've really been like pretty inactive on YouTube and my own podcast. So I need to sort of try and get back in a routine of doing that weekly. But I think the plan is really just, ultimately sort of trying to monetize Making Money Simple to the point where I can do that instead of my full-time job in accounting. So it's not at that point yet, unfortunately. But I think by focusing on the YouTube and the podcast, try and get them monetized, then obviously do like the odd coaching call, sell a few digital products, do the odd sort of like brand deal. Hopefully over the next like couple of years, I can get to a point where I can do it full time. But in the short term, I'm not too sure in the short term, because I've now got like done a workshop, done a loads of different social media platforms. Maybe I need to try and develop like a course or a mastermind group or something else. I'm not too sure. I need to have a think. But for now it's just focusing on making content, which, as you said, does take a while. It's quite time consuming, especially YouTube and the podcast. So focusing on those, and then really just like having a good time, having the odd night out, having some fun.
I love that. Love that you add fun, because that is what it's about. It's also about enjoying your life. You need to enjoy your life as much as possible.
Exactly.
Thank you. Have you got any final words for the listeners?
Stop waiting, start investing.
Name of your book. Make sure you check out Ryan's book. I'll put it in the description.
I will actually say though, sorry, quickly, so that book does have a lot of the stuff that we did cover here, to be fair. If you want to learn more about this like strategy that I follow. But also, if you have any questions, just DM me on Instagram anytime. It might take me a couple of days to get back to you, depending on how busy I am at work and stuff. But feel free to DM me whenever you like, and I'll probably send you a few voice notes trying to help you out. But DM me any questions. And then other than that, yeah, just obviously get started with investing. As we've said a few times, even if it's with small amounts, you will not regret investing.
Yeah,
No
you
way.
would definitely not. Once you start, you'll be like, why did I not start this earlier? We all feel like that. Where can people find you across your social media channels?
So just making money simple, pretty much on everything.
Across Twitter, YouTube,
podcast,
Instagram, and TikTok, right?
Yeah.
Yeah, and you got a podcast as well. Yeah, awesome. Yeah.
Just
and I'm featured on the podcast too.
yeah. You're one of the first ones I think done the first time buyer podcast. Yeah, make money simple on every social media pretty much. I should come up, hopefully. Yeah.
Awesome.
That's where you can find me. But no, thanks for having me on, Atsu. It's been a pleasure chatting to you, mate. Always love a good index fund chat.
It's been great. Yeah, it's been a great one. And listeners, I hope that you definitely appreciate that. Thanks for taking the time to listen to this episode, and I'll speak to you next week. Have a great day.